Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it going forward now, as the virus turns. Yes, of course, we know it's dominating the news stories these days. You can't escape it. It's all over the place. We have to deal with it. Our world is changing as we speak. Today, I'd like to talk about defaults and what mortgage foreclosures, what the banks are trying to do, and how this is going to play out. I think this is very important. And by the way, if you're not already a subscriber, please help my channel grow. Click the subscribe button on the bottom right of the video. Thank you very much. All right, so as I said, we're going to focus on defaults today. And this to me is, I was able to participate in different ways in the last housing crisis. And if we go back in time, we can, draw a lot of parallels from that. Granted, there are things that are somewhat different, but there's a lot of stuff that's going on that's pretty much the same. But in the end, it's usually a number of things that kind of hit at the same time to push us over the edge. So, I was, told that we're now referring to 2008 as the Great Recession as opposed to the Great Depression. So that's a little different. But at that point in time, there was a number of issues that happened financially, and housing was one of those that contributed to the Great Recession. Well, we've had a bunch of stock issues the past little while. Yield curves are I guess you could say, are inverting. A lot of financial analysts are predicting a recession in 2020. It's just tough to sort of peg the date. Now we have the virus, which is pushing things, over at an exponential pace right now. So this is the events that will probably lead to some problems in housing. So I like to track default rates. So obviously, we can basically say that, how can I put it? Some locations are going to have higher default rates than others. I mean default rates, you're not paying your mortgage, you're not paying your car loan, your credit card, whatever, all right? And I guess you could say that, we're going to see, with housing values being up, people are able to maybe refi their homes and therefore pull money out or reset their mortgages and pay off what's owed. So there's potential where some of the default rates will slow down. But we know, again, citing my last video, auction.com, saying that the experts predict that we're going to see an influx of government-issued loans that are going to go into default and more. So that's what we're going to find here. So basically, 89% of the report said they expect government-insured foreclosure and REO inflow to increase in 2020, the highest among four product types profiled as an option in the survey that they took. So keep this in mind. So, defaults were sort of ticking along, a little bit ebbing and flowing here and there. Now, they were ticking along, again, not much change, not a heck of a lot of growth. Certain areas do grow, though. But if you take a look at nationally across the board, it's just kind of been maintaining. Even though we're at, high value pricing, it's been maintaining. Now we're going to start seeing some changes, and it's going to sort of balloon. This is what happens. Okay, keep that in mind. How coronavirus is already threatening the housing market. This actually is a article which it'll be in the link will be in the information section of the video. This is actually a mortgage firm CEO is saying out loud. So it's a mortgage dude is saying lenders must prepare now for a U.S. recession, and the reason being that the coronavirus pandemic threatens financial markets and sends the U.S. economy into potential recession. Those of us who lead the mortgage firms must take swift action to prepare for the worst. The last time financial markets suffered such a precipitous drop was during the 2008 Great Financial Crisis. He was CEO of City Mortgage back then, and he saw firsthand how the housing market became paralyzed. So he's now the CEO of the nation's third largest housing specialty lender, and he's applying some lessons that he learned from the last crisis. Here's what the mortgage industry should consider doing immediately. So this is where things have changed a little bit, and this is very important, okay? Increased liquidity. More than 50% of U.S. mortgage originations and 45% of servicing are provided by non-banks. All right, so these aren't your Bank of America and your Wells Fargo, big banks that are FDIC insured. These are the non-banks, or what we call the shadow banking industry. And the thing about these non-banks is that they originate the loans, but they don't portfolio their own loans. They go out and they sell their loans out there, so they're exposed if something like this does happen. So he did say he wrote about this thread a year ago. Non-banks originate loans and sell them to other entities such as Fannie Mae and Freddie Mac, which pay non-banks an ongoing fee to service the loan. The lifetime value of this fee is an asset known as a mortgage servicing right. Non-banks use mortgage servicing rights as collateral, so they can borrow money from banks to use as working capital. So you can see how it's sort of integrated. And as a side note, so a non-bank is borrowing from your Bank of America, Wells Fargo, whatever. So they're borrowing behind the scenes, and then they're selling their loans to other entities. So basically what they're saying is that keep in mind that 40% of these non-banks didn't make a profit in 2018 because they're so thinly capitalized and they're so tied to rates that significant changes can throw them off. And basically, the issue is that poorly performing banks will have a hard time getting capital, and that's going to cause some pain in here. So the non-banks will face a liquidity crisis, which is what we're sort of going through right now. The Fed keeps pumping more money into the economy. These non-banks will face their own liquidity crisis, and this could be a domino effect as well, too, causing other problems. So just be aware of that. Mortgage modification programs. So basically, several large financial institutions are projecting that the economy will fall into a recession. And obviously, as we said with Goldman Sachs the other day, the layoffs are starting. We're going to see much more of that going on. So more non-banks, along with banks, are going to have to deal with these loan mods or ways to work around the situation here if people miss payments. So again, while we can't control market events, we and other lenders can and should take swift, immediate action to help homeowners keep their homes. So already the mortgage industry is aware of this. They see this coming. They're starting to realize it right now. They're going to put things in place, and I want to talk about that. So I'm actually leading up to something that I'm talking about here. All right. So Bank of America will allow borrowers to pause their mortgage payments. So coronavirus forbearance is here. So what we've seen is that, FHA has talked about this the other day. Now we're seeing individual banks coming out going, we will work with you, we will help you. I want to be clear here, though, is that pausing your mortgage payment, and let's step back. Again, this is in the news. People are reading things. We're all stressed. We're all panicked. What are we going to do? We're worrying. You may not hear it correctly. You may not listen to it correctly. You may not read it correctly. That's why I want to take the time to explain this here. So if a bank allows a homeowner to pause their mortgage payment, what they're doing is something called forbearance. So you have to again, it's not automatic, okay? You actually have to take the initiative and contact the bank and talk about the solutions available to you. You contact your bank. If for whatever reason you qualify and fit into the box that they say, yeah, we can pause your mortgage payments. It's not automatically 12 months. They might give you 3 months, 4 months, 6 months, or whatever. Maybe usually up to 12 months in the end, if it keeps going on longer than that. So you're pausing your mortgage payments. The bank is not deferring the mortgage payment, nor are they forgiving the mortgage payment. Because again, some people I've already spoken to think, oh great, I don't pay my mortgage for 12 months, everything's great. It isn't great, because this is called forbearance. So at the end of the forbearance period, whether it be 3 months, 6 months, a year, whatever that number is, the bank goes, okay, pay up. I want my money now. Now we've given you the leeway to not pay, so you should have saved your money up or accumulated more money. Now you need to pay us 3 months, 6 months, 12 months worth of mortgage payment. That's how people get into situations here. So you've basically, during the forbearance period, they're not going to negatively report on your credit. They're not going to add fees and penalties and interest and things like that onto what's owed. It's a little bit of a reprieve there, but at the end, you got to ante up 12 months worth, 6 months, whatever the number is that you've not paid. Now, this is where people can't recover. So optically speaking, hey, the government's saying all these great things, don't have to pay. The banks are saying this as well too. So optically, it's like, hey, we're good people. We're commiserating with what you're going through. We're giving you a break here. But when it's over, they're going to want their money, okay? And you know what's going to happen? I'm assuming that if the average person is out of work or being laid off and can't pay their mortgage for 2, 3, 4, 5, 6 months, when they get back to work or when things change, will they be able to earn double the income that they normally would have worked or earned over that time frame they didn't to save to pay off what's owed on their mortgage? Most likely not. So this is how we're not saying we're getting played, but this is how it all plays out. So optically, the banks are being good people because they know that, guess what, when the time comes and the forbearance is over, Now you're not going to pay. Now you're going to try to do a loan modification. You're not probably going to be solid enough that we can pull that off. Then we have no other choice, but we have to file the foreclosure. That's how this is going to play out. So everyone's happy now, going, oh, thank God, I've got a reprieve. This is just deferring what's going to happen in the future, as far as I'm concerned. So that's, so again, Bank of America is saying, they're suspending their own foreclosures and evictions for at least 60 days, kind of like FHA. So everyone's kind of falling in line with what the government's doing. So that's okay. Again, like I mentioned last video, the things that are in process with sale dates and eviction dates, once the 60-day moratorium is over, it's just going to get reset. So you've bought yourself maybe 60 days, and then when they reset, another 30 days. So now is your chance. So if you're in this situation as a homeowner or a renter, at least you got some, you might be able to, contact somebody to do a short sale, figure another strategy about where you can move to, etc. So start looking for a different place. Like, there's things that at least you bought yourself some time, maybe you can maneuver and figure things out. So just realize that this is going to happen down the road. Again, you need to contact, if you fall into this category, you need to contact your bank. It's not automatic. I know outside in the world that people will think, oh, I just don't get to pay, and that's great, and they're not going to realize that they have to contact to initiate that. So please don't make that mistake, all right? Again, everything is on a case-by-case basis. It's not global, it's not ubiquitous. So when you do things like that, they're going to want some financial information, and if you've got $100,000 in the bank but don't feel like paying your mortgage, or you're in a financial, say you got laid off, they're going to go, well, you know what, you've got your savings, you need to use that and pay your mortgage. So realize case by case, and this will all be figured out. I've already heard some of the discussion that, oh, we'll just take these non-payments and put them on the back of the loan. Well, you know what? That doesn't really happen, and I wouldn't buy that at all, because going back to the last housing crisis, that was not available. People were trying to contact their lenders. It wasn't very effective, again, granted, because of the volume, and things didn't work out. A lot of people were trying to do loan modifications and just didn't hear back from their lenders, or the loan modifications didn't make sense. Like, the lenders wanted, pretty much close to what your payment was that you couldn't do, or bringing some money to the table to appease them and make it somewhat current. You can't do that in this situation. So people just, the loan mods failed, and guess what? People fell into foreclosure. Now, and I know that a lot of people who have gone through loan mods in the past 3 or 4, 2, 3, 4 years are back to redefaulting as well too. So their foreclosure case is going to kick up. So I'm just trying to point out, saying that optically and socially, it's what we want to hear, that banks are going to work with us, the government's going to work with us. But when you think about it, what happened last housing crisis is a good example, and how these policies work. Now, I'm not saying they won't work for you. It may work for you, but it's not going to work for 100% of the people. And some of the things that we are being told now may not be the case when you actually call your bank and try to figure stuff out. So my position would be that we're going to see a little bit of reprieve for mortgage payments, because people will jump on this, but we will see an onslaught of foreclosure filings coming after this is done, because quite frankly, we're just not going to be, it's going to be like last time. I mean, the capacity is going to be huge. The banks already know what's coming. They're already preparing, and they're trying to, we'll stave it off, but they know that this will be the future of where things are going to go. All right, so this was Bank of America saying that, and I pulled something that came in yesterday. Wells Fargo suspends foreclosure sales and evictions. So it announced that it has suspended residential property foreclosure sales, evictions, involuntary auto repossessions as part of its comprehensive steps to help customers, communities, employees grappling with the impacts of COVID-19. Which, listen, as I said, it's great, but realize that the company is also offering fee waivers, payment deferrals, and other expense assistance for people, credit card, auto, mortgage, small business, and personal lending customers who contact the company. So number one, contact the company. If you don't contact, nothing's going to happen, and they will proceed with the normal course of action they would under any normal circumstance, virus or not. So please keep this in mind. So I would assume that, if B of A has said this, Wells Fargo, who's the next bank who's going to say this? Probably Chase Bank, JP Morgan Chase, that will probably say it. Whether the non-banks will do this, I don't know yet, because, again, that's going to hurt them from a liquidity perspective. So we'll see how the non-banks kind of work out. Does this smell like a potential bailout coming up? I don't know. I mean, in theory, the non-banks don't normally qualify because they're not FDIC. They probably don't fall into what should be bailed out, but we'll see what happens in the future. The non-banks are underwritten by Ginnie Mae, which is a little different. And again, the structure of them are different than traditional banking as well too. So keep that in mind. That could be a curveball that's going to throw stuff in the industry. And also realize that, again, the non-banks over the past couple of years have been the issuers of originators of most of the mortgages. So 67% of the mortgages are from, PennyMac, Caliber Home Loans, Quicken, Rocket Mortgage, all Carrington, all these non-banks, shadow banking groups have been originating the loans, a lot of them FHA backed, so you can see how this is all kind of fallen into place here. And with all these, sort of originations, we've had a, decrease in lending standards, increase in debt to income ratio, all these little things. This is how I think it's going to play out. It just may take, we're going to start seeing that right now. I know that investors are already out swimming. They always say the sharks are in the water when they smell the blood. They're already out now. A lot of people are inquiring because we know that people are going to need to sell their homes or cash out their investments in order to accumulate the cash to survive. And investors with cash can swoop in and demand discounts to move things going forward. So that's my prediction. So sometimes I read your comments. I don't always read comment back because I'm kind of busy sometimes, and I just figured, there's enough smart people that are commenting that put people in their place. But everyone's saying, well, why should I wait? Well, this is the number one question. When do I buy a home? Now, the difference is, are you buying for a primary to live, or are you buying for investment? All right. People always say, Randy, how come you're telling people to buy? I'm not telling you to do anything that you shouldn't or don't feel comfortable doing. My point, though, is that in certain instances, there might be some great opportunities from an investment perspective to get in and buy a property, because if someone has to sell their rental property for their own situation, guess what? The cash flow is still there. So it's still a decent property. So that's where we can take opportunities to increase your rental portfolio, get a cash flowing property, etc. So there's some great things that are happening, and we're getting access to a lot more of those properties. Where I see this going farther, so investors are going to come in, they're going to, we'll call it cherry pick the people, all right? Then we're going to see some price declines. Then we're going to see a lot more foreclosures happening in the marketplace, and a lot more people who are going to need short sales to stay in their home longer and to leave, without getting foreclosed on, leave a little nicer, a little more elegantly out of the situation, get their debt sort of negotiated and settled, as opposed to losing everything through a foreclosure sale. So that's the difference. We'll talk about that in the future. But this is kind of my thing. So my prediction is, I just look at what's happened in the past, what's happening right now, the domino effect. I do believe we're going to see a lot more stuff going on right now in the future. I've listened to a number of, we'll call webinars or Facebook Live events, whatever, people that are talking about the industry, and everyone's sort of saying that this will be a boon for distressed property. And if you're a real estate investor, you want to get in the game right now, because remember how it actually works is that you don't want to invest at the peak, because it only can go down from the peak. You want to invest when it's in the trough area or on the way down, because it will normalize eventually and eventually come up. So you sort of want to get it in here, not up here. That's the whole point of all this. But as I always mention, contact me directly if you want to talk about some investments, because we are getting our hands on a lot more property opportunities. A lot of them are fix and flip, a lot of them are rental properties, all right? So I think people might want to engage in that. With respect to the future, where things are going, all right? Foreclosure auctions, doing short sales. That is something that anybody can do and learn. You don't have to, you can buy a short sale property as your primary residence. You just have to know how to do it. And for those of you who've asked, yes, something at the auction, so if you're buying a foreclosure auction, typically takes cash to take the property at the auction. You can't buy something at the auction, a county auction, and then say, okay, in 30 to 45 days, I'm going to close on it with a loan. It doesn't work that way. You got to bring cash the next day. But a short sale is a little different scenario, all right? It's a contract between you and the seller. It goes through a process with the lender, and then there's a close. It's a real transaction, real retail transaction. It's just ways to go about it to actually get yourself some more value out of it. And a lot of real estate agents don't really know how to manipulate the components to make it fruitful for a lot of their clients. So that's what I do. It's what I know. And if you want more information about it, please reach out and email me with your name and information, phone number, so we can communicate. Other than that, if you want more information about investments, training, whatever, same thing, reach out to me again. I'll try to do more videos and not keep them as long, but this to me is very important. We're going to see more of how the banks are going to help you, the homeowner, the average person out there. All I'm saying is that just be aware of what's going on, be aware of what they tell you, and don't just think, oh, I don't have to pay or I get off scot-free, because in the end, that's not what they want to have happen. All right? Take care, everybody. We'll look forward to speaking with you shortly.